I think the market's been at a fairly high level for a long period of time, and I think you're seeing a natural correction in those markets to kind of reflect probably the jitters about global growth. Oil is a double-edged sword. If you think about oil, we're paying $70 less a barrel than we were a year and a half ago. That's a huge positive for the U.S. That's going to have a dividend at some point. But I think the oil plus China has spooked the markets a little bit. I don't see a fundamental systemic issue like we had in 2008, so hopefully it's just a correction. If I knew what the market was doing, I'd probably be on a boat in the Mediterranean, but I would say this looks to me, from experience, like more of a correction than a fundamental systemic problem. Well, look, it's still fairly high growth in China, and really this is an economy in transition from an export-driven manufacturing economy to a services economy. So I was just in China about a month ago. There's still hustle and bustle there. Service businesses are growing. We have a very robust fund over there, invested in a lot of businesses. And by and large, the Chinese government has managed the economy very, very well. They've managed the market economy, had huge growth. You can't grow for 15% forever, and 7%, 6.5% is still a pretty good level. So I think there's been some overreaction to that as well. It's more of at some point, the world is realizing there's a slower growth period coming, and markets were highly valued. So I simply think you're seeing a correction. Well, the Fed is taking a very cautious approach. They want to see a good economy. Their major goal with interest rates has been to fight inflation. We haven't had much inflation for a long period of time right now. So I think they're using a proceed with caution strategy, which I think is the right one. Well, you see this correction, so that's going to make better values in companies in general, and when you see that, you often see deals happen. So we've just raised 3 new funds, and so we're excited about the fact that companies are reaching a more reasonable valuation level where we can see how we can transform them, how we can grow them, and make a good investment. Well, what we look for is really fundamental value. The Bain Capital model since day one has been a team of folks coming out of consulting that goes into companies, works with managements to transform those companies. So most of the successful companies we've done have been mergers, have been growth opportunities, and you want to buy them at a reasonable price and then transform them. Well, I think it's a real problem because they count on that fixed income, and we've had low interest rates for a very long period of time. This quantitative easing, the monetary policy is about as low as you can go, so it's caused a large problem for retirees. I guess what it means is you have to have a diversified portfolio, you're going to have some equities in there which have shown better growth, and I think the Fed will get back to normalized interest rates over time. It's a tightrope they're walking, because if they raise rates too quickly, you're going to see another economic contraction. So I think they'll do it over a longer period of time, and hopefully that problem will solve itself, but it's going to take quite a while. I think the world is nervous about the state we're in now with the situation in Syria, with the kind of Shiite, Sunni conflict in the Middle East, which is causing all sorts of issues. Countries like China in terms of their sovereignty and building the Sakhalin Islands, those kind of arguments. So there's a sense that we're entering into a period where there's a little less stability politically in the globe than there was 10 years ago, for sure.